I've heard the term legalized mafia when referring to insurance. When back in the old days, when it was the mob and all that stuff, they did go and say, hey, you have to pay for protection.
If there is a mafia in finance today, it's the card network.
It's one of the oldest industries as well. So, I mean, it's like insurance is boring. They'll say that they want the job, but then really they don't want the lifestyle that goes with it.
If you don't have alignment going in, you're just going to have friction the whole way.
If you just keep doing it incrementally, it works out. It's like going to the gym. If you go every day, in a couple months, it's going to be good, right? But it's not today or not tomorrow, not this week.
You just keep tuning it up and you just keep doing just get a little bit better every day. And you look back after 10 or 20 years and you're just shocked how far you can take the business if you do it that way. But the core view here is the bigger you are, the more people can invest in you. If you bought a business that was small and then you grew it, that'd be a super valuable asset. But if you're growing organically, sky's the limit.
What's one piece of advice that you give an insurance agency owner going into the future?
And as long as you're pointing in the right direction, you just keep. So craziest thing for me professionally, I negotiate deals with companies to invest in them or acquire them. We were recently doing that with one company out west. We gave terms that were super fair. They came back really hard, as companies do. And you ask yourself, okay, fine, maybe they're just being tough. You come back with terms that you thought you'd agreed on, and they say, oh, that makes sense to us. Then they come back even tougher. And you just get to this place where this just looks like I'm not a masochist. I'm not just going to sit here and keep being pummeled so we pull out the term sheet. But those things happen. My name is Brandon Wolfe. I'm managing partner of Jordandene Partners, and I'm an insurance dude.
Boom. You nailed it.
Tried.
So you're saying over a third of the acquisitions that you guys have made have been through insurance related, right?
Yep, absolutely. So Jordan is a firm that invests the first institutional capital in growing bootstrap businesses. We don't use leverage, and we try to invest in industries that are slow to change. And property and casualty insurance services is absolutely one of them. I mean, when you think about what Warren Buffett liked about insurance 50, 60 years ago, a lot of it's still true today. And whether it's AI or not, we think it's going to be true 20 years from now. So property and casualty is one of our favorite places to invest. Although we don't do balance sheet stuff like Buffett did. That's too risky for my blood.
I've heard the term legalized mafia when referring to insurance.
Yeah. Well, it's the nicest mafia on the planet,
Right. It is interesting though, right? Because when back in the old days, when it was the mob and all that stuff, they did go and say, hey, you have to pay for protection, right? I mean, it is interesting.
I would say this. I would say insurance is more of a social good than the mafia was, right? Supposedly the mafia skimmed off 1% of GDP at the docks and stuff like that. If there is a mafia in finance today, it's the card networks like Visa, MasterCard. That's like an interesting little cartel. But one of the things that we love about insurance is that at the end of the day, it's a social good. You're required to have it. And, think about the folks in California. I know that's a big theme of y'all's podcast. Think about the folks in California who may or may not be able to insure some of the biggest purchases in their lives. I mean, that's something you got to figure out. So
insane.
Yeah,
100%. So if you're an insurance agent, you're like, why should I listen to this? Because A, you're going to know the difference between captive and indie, especially when it comes to private equity. And then you're also going to learn how you can set up your agency so you can sell it for more. So if you want to make more money, listen to this. How do you like that for a hook?
Makes sense to me.
I think. Oh, go ahead.
Well, one of the things that we were talking about right before we started is captive versus indie. Everybody says the grass is always greener on the other side for the insurance agent. But really, when it comes to private equity, there's only one path that you can take with that, right?
Most likely, because if you're captive, you're really dependent on that carrier. So if you're indie, you actually have control of your destiny. I mean, when you think about how an investor thinks about anything, whether it's a public stock going down, they usually have a mental checklist, maybe even a required checklist, just to make sure they're checking the boxes. And concentration risk is always one of those. Do you have one customer who's X percent? Do you have one supplier who's X percent? And if you're a captive, that is always going to be the dilemma that you live in someone else's world, even though it could be lucrative.
Yeah. And I know with our captive, the captive that we're with, that we're not allowed to say, just FYI, it's in the contract that you can't have any other owner. So it's got to be that business owner. But as a business owner, we always think about and Craig and I talk about this all the time, what we're doing is investing, whether it's investing time, we're investing in our agency or anything like that. So a lot of the same principles, I think, apply to both, whether or not you are the business owner or, private equity as well.
Well, and I've never had the chance to invest in or look at a captive business for that reason. But if you own one captive business, could you buy multiple captive businesses? I feel like I heard one of the guests on here recently say that. The fellow was a basketball coach. He bought one, then he bought another. Can you buy multiple captives if you're solely owned?
Yep.
That might actually be the opportunity, because then all of a sudden it's like, hey, none of these people in Midtown Manhattan or elsewhere can do it, but I have the trust of carrier X, and I can go out for a lower valuation by virtue of it being a more limited market of buyers, aggregate that. So something to be said for that strategy. I just can't pursue it, unfortunately. You guys get to do it.
The challenge, it's not necessarily a free market, right? To go and just buy them. Like if I want to sell one and Jason goes, I want to buy one. Well, the carrier itself holds the keys to that.
Got
right?
it. Okay.
So there's all these approvals and it becomes a carrot. Or a stick.
Which again, it's funny. I mean, I'm a student of business history. Some of the biggest businesses made no sense when they started, and they wound up being something like truly special. So I could see someone running a playbook where they kind of figure out what their carrier is looking for, and they just serve them up what they're delivering to their investors. Because many of these carriers are public companies. They're trying to hit a number, hit a target, whatever. You play into that. You might actually, you're right, it's not a free market, but then it winds up being an advantageous market for you if you pull it off. All that being said, this is exactly why I like the indie market. This is why I stick to all things like, private and indie in general.
Well, we have some friends too that have aggressively bought agencies, but they aggressively sell as well, and they've positioned themselves the opportunity to be able to constantly purchase. So it's a killer strategy. But I would love to know from an outside perspective, especially from, private equity, is like, what do you guys look for in insurance agencies?
Sure. So I think every firm is looking for different things. I mean, maybe just taking a step back, here's the way I would think about private equity broadly, because private equity is a lot of different things. On the really small end, you've got venture capital. This is funding a business that may or may not have a viable business model, but it could wind up to be one of the biggest things ever. You've seen that in agencies a lot with insurtechs. I think we all would probably agree a lot of those insurtechs never really had business models. They take other people's rails or other things and they put a wrapper around it, but you never know. After venture might come something called growth equity. It might be a minority investment. It could be a majority investment, but this is a business that's still in growth mode. It may or may not be profitable, but it's probably at least like break even. The other end of the spectrum is leveraged buyout, which is growth is slower. Debt is being put on the business to make the acquisition. This could be a business that's 20 million in revenue or 2 billion, 20 billion in revenue, right? So within agency, like venture, outside of insurtech, there's just not often a lot of reason for it. You should use friends and family capital to build your business. So growth and leverage buyouts are really where you find a lot of it. So candidly, I don't know if you guys appreciate this because you're in the trench of agencies, but brokerages are one of those things that are so hot with private equity investors that as our firm, we mostly stay away from it. Like we admire the industry and we think we're eventually going to find a team that we back to go build a category killer. But on purely valuation, it's one of those industries that is like catnip for private equity folks, whether they're Midtown Manhattan, Chicago, or elsewhere. So why is that? Part of it is just because it's been a great asset class to invest in for decades. And unfortunately, many investors are momentum investors and they won't admit it. But the second piece, and this really gets to what's so great about the business, the revenue model is really premiums go up over time for all sorts of reasons. Commissions don't tend to go down much over time. So you have pretty good revenue growth and you have a super capital light business model. And you have one that is really just kind of ripe for consolidation. I mean, that's what Gallagher's been doing for 50 plus years. And it's just incredible to see what they've built that way. So there's a lot more nuance that goes into it, but the really simple answer is great revenue quality. It's very likely to grow and compound, and it's capital light. And you always have the opportunity to aggregate businesses around it.
Yeah, I love that. It's one of the oldest industries as well. So, I mean, it's like I'm sure a lot of the businesses you see are newer. You know, those are the exciting ones and those are the fun ones, but insurance is boring. Obviously, insurance is boring, but man, it's stood the test of time.
Fun is a great way to lose money in investing if you're not careful. I mean, like we're always looking for things that are slow to change, and that's again one of the things that I think if you're in agencies day in and day out, you can underappreciate. Like people think AI is going to disrupt it. Not really. We can talk about why that is. The internet was going to disrupt it. Not really. Like at the end of the day, there's still so much trust that matters for an individual. And it gets more and more complex every year, you know? So if you have one of these business models where complexity is good for it, relationships are good for it, and technology is just an opportunity for efficiency, like give me 10 or 20 years from now, and I have a feeling this market's going to still be a great market to invest in. It's just what valuations can someone pay? But again, that's where, as an investor, like I can really help a company, but the operators are the ones that are driving the company. So if you're an operator listening to this, the world's your oyster in this industry. That's the good news.
So you come in, if somebody approaches you and they have, an agency model and it's looks good and all that, what are the things that you're looking for? Like, what do you look through if somebody's trying to take their agency and tune it up right now so it looks good? What would they do?
Yeah. So two different answers. What I'm looking for and what somebody would do if they're tuning it up. You know what I mean? Because I like to be part of the tuning up. I don't like to be tuned up when they show up per se. But like, right. Yeah. What I'm really excited about first and foremost are the people. I can't emphasize that enough. That you can have a great business model, but if you run it like a lifestyle business, that's totally fine. You just have to know what you're running it as. But if you're instead running it as a growth oriented, we want to be a category killer, that's something that gets really exciting to me. So the next question is this person realistic about their aspirations, or are they just totally delusional? Because we've all met these people, especially in insurtech, who are like, I'm going to build the biggest industry. I'm going to build the next Gallagher. You can't build the next Gallagher. You had to be there 50 years ago, right? But you can still build a fantastic business nonetheless. So after that, what I would really ask myself is sort of, what are the end markets? Because I think that's the thing that people probably underestimate. Like you can be in the best business lines and it's a huge benefit to you. For me, I'm much more of a, and I know that this is very little B2B, but I'm very much like B2B and complexity driven. But if I'm in the retail markets, I'm still looking for complexity. I'm still looking for diversity. So, and this gets back to the captive versus, independent. You also want to have really good business mix, like not a lot of customer concentration, not a lot of supplier concentration, not a lot of product or otherwise concentration. And so you roll all that together and you should see a business that has been compounding sustainably. There's no growth rate that you have to reverse engineer it to. Like you can always try to grow X or Y%, but you might break the company or underinvest. So see nice compounding to the upside, see expense control. And then if you have that management team that wants to build a category killer, they then start to generate some cash and they ask themselves, what do I do with this? For some people, it's, I'm going to buy a boat. And for other people, it's, I'm going to build a bigger company. And if you fit in the latter category, that always gets us really excited.
Right. And that's what we talk about all the time, because I think agents, this happened to me in the early stages, right? You get a whole bunch, you get these big bonuses. I mean, that's the key. And I think what keeps it exciting for us is if you put together the formula to create some growth, well, then now you have this cookie cutter thing that gets you that bonus, right? So instead of being concerned about making that cash flow monthly, you can come pretty close to break even, but then get paid for it on the back end, right? Every year. Yeah. And a lot of agents, and including myself at one point, would go out, I got 400K, now I can buy things, right? When instead, and the cost of that is detrimental, right? Because you have to pay 35% of it to Uncle Sam when you take it out. Yep. And now you have the balance that you go buy depreciated assets with, right? Versus taking it, the whole 400K, and pumping it into leads and callers and all the things that make a agency work. So I don't even know where I was going with that question.
By the way, what you just described sounds like a private equity investor too. Like, I just got a bonus. What am I going to buy? It's human nature. I mean, look, the human brain is not good at compounding, but that's what everyone does when they really amass generational wealth. They look at a model that works, they execute it, they tune it up, which I realize I skipped in your question. Sorry, we can come back if you want. Okay. But like, you just keep tuning it up and you just keep doing the right things, small things, right? Like just get a little bit better every day. And you look back after 10 or 20 years and you're just shocked how far you can take the business if you do it that way. If you don't buy that boat.
Yeah. That is amazing, because there's points where both Jason and I strategically leveled up and took big gambles and not gambles, but educated decisions that seemed risky and scary, but we did it and then it paid off. And it's so easy to just stop, right? To say, I don't know if I could do that. But really, I mean, like to your point, if you just keep doing it incrementally, it works out, right? It's like going to the gym. If you go every day, in a couple of months, it's going to be good, right? But it's not today or not tomorrow, not this week.
So this is one of those places where investors actually try to add some value too. So when an investor invests, they almost always do some capital to grow the business, but some capital in what's called secondary, which is really just de-risking it for the management team. So when you think about this, and you just described what every entrepreneur feels, even if they're not in agencies, you've put your blood, sweat, and tears, probably your life's work, all your money into this thing. You want to take it to the next level. But if you take it to the next level and the rocket ship blows up on the launch pad, then you're left with absolutely nothing, right? And if you blow it up on the launch pad by yourself, you sort of feel like an idiot because everybody's pointing at you like, why'd you do that, you crazy person? Whereas instead, the whole kind of idea of having an investment partner is you take some liquidity, you now are not going to go broke based on this thing you built. And now you actually hit the escape velocity. So, I mean, my favorite thing about just like building a business or investments period is it's all human nature. What you guys are describing, I see it outside of agencies too, which is the fun part.
100%. Yeah. It's all the same, right?
Yeah.
I mean,
just people.
Yep. So when you go into a business and you tune it up, I mean, what's the playbook for that?
So the thing that's funny is private equity is just like, there's too many private equity firms already, and they all come in talking about their playbook. You know? So the first thing I try to do is say, I don't have a prescriptive playbook. You can just see people like kind of sigh. Well, the worst part too is playbooks often almost always mean like cost cutting and other stuff that people don't want. So, I mean, there's three things we do broadly, and like the bullet points that go underneath them are enormous, but we want to find places where we can do tuck-in M&A. That is where all owners, including the operators, can do better because you build a bigger business. And plus, tuck-in M&A is usually at a smaller price than what the value at that business is. It's just smaller. There's a smaller market. It's a little bit what we were talking about earlier. So help with tuck-in M&A, unleash our network of advisors on helping the team get better. This is like C-level people who have been at a wide range of software and service companies. They can help on anything from general management on down through finance and HR. And then lastly, we want every company to lean into automation. And I think in agency, that's a really big deal. And, you know, automation going forward is a chance for you to improve your margins, in some cases, improve your revenues. But at a minimum, the way we see AI is not the only thing, right? Like AI is just a piece of automation. There's a lot of other types of automation out there, but AI and everything like it over the next 5 years should make every business more profitable as long as you're in a slow to change industry like agencies. So each company, you know, you'll look at the management team, you'll look at the contracts, you'll look at the customer mix. You'll definitely care a lot about the sales team. I mean, everything, as you guys know from agency, everything is sales. Like you can sell an okay product and do exceptionally well if you have a great engine for that. So we'll get really in the weeds, but there's kind of three high level things or what we do universally across companies.
I love it. Yeah. And you can apply this, I mean, to an agency. I mean, I love the way you said that. So you go in and basically you take all of the people that know what they're doing and help the people in the companies that might not have that kind of training in the past, and try to merge some systems, see what you can improve in that aspect. So you're really just refining processes, refining sales systems, and then
we're trying to find people that have a good thing going, and then you get a little bit better every day. You know, and this is something I would say to all listeners, there's a tendency for private equity people to act like the smartest people in the room when of course, like they're not, you know, I mean, it's just, they have different functions. We all do different things, but you know, if someone
they just have the most money in the room,
well, but they're acting on behalf of other people, you know, like schools and individuals and everything else. So they might have the biggest ego in the room. That is the one thing that is theirs that they have the greatest of, you know, but like in general, you know, when someone comes in, there's this tendency to be like, I know more than you do. When in reality, like, every time I work with a team, I know capital allocation better than they do. They know their customer better than I do. I have to listen about their customer. They have to listen to me about capital allocation. And if we can't have that conversation, it'll just wind up being like that craziest situation at the top of the call where you're just talking past each other and you're like, well, this is silly. So,
yeah.
It's so crazy. What you described reminds me of that. I don't know if you've seen that Elon, his requirements before automating, but he talks about the 5-step process. It's question every requirement. So challenging the assumptions that are already, you know, that are already going on. It's delete unnecessary parts or processes, then simplifying and optimizing. That's where you throw in the automation and then accelerate cycle times.
Yeah, makes total sense. I mean, like, why try to get better at something that's a waste of your time anyway? You know, just cut the thing out and just like, you know, move on. Well, it's been wild too. Like even outside of agencies, I mean, look at what's happened in the past couple of years where big tech firms have gotten more efficient. They actually have gotten more efficient. You sort of take a step back and you realize there were just a lot of people sitting around in these companies, So, but, with the companies we're looking at, they're much smaller companies. So you wind up going in and, it's the kind of businesses where the assets walk out the door every night, so to speak, right? So all problems are sort of people problems, and you just kind of figure out like who's resistant to change, who maybe is a little bit too moody, who can be improved, who can be up leveled, and who probably is just going like a trit. But candidly, what I've been really excited about is the companies we've worked with have kept their staff at 100% and grown it. So that's been great to see.
Oh, that's cool.
Yeah.
What do you do when people are resistant to change?
I mean, it's the same thing you guys would probably do, I hope, right? You figure it out as soon as you can, and you have the tough conversation, I mean, and the tough conversation isn't like you're out. The tough conversation is, this is where we're going and why. Do you agree with that? And if you don't agree with that, is there a better path that we should be thinking about? And if the path they're thinking about is like, I kind of like the way things were or something like that, there's your answer right there. I mean, it's not good for anybody to stick around too long when, you have a growth mindset and you're really just trying to compound the business. There's a lot of people who just rather just sit in place, and that's never going to work for what you guys are building or what we're building.
Well, that's what the carriers have identified and are cutting that out.
Oh, yeah. There's a lot of that going on at the carriers, I think.
Yeah. I mean, which is fine. I mean, we've been in growth mode for a long time, so it doesn't affect us for the most part. But it is, you hear a lot of rumbling about the folks that wanted to, I try to empathize too with, I've done it for 40 years now, and I had planned to, have this be the case, but you have to be ready for change, right? And along those lines, like I think that's one of the fears of private equity too, is they're going to come in and change everything, right? And take away that entrepreneurial mindset out of the company. Is that, what's your firm's philosophy?
No, I think it's totally right. And I'll try to talk broader than my firm too, just to be helpful to the listeners. Okay. I would say this, like every private equity firm is different. You should spend time vetting them the same way you'd vet a partner, because they absolutely are a partner. They're going to be one of the most important partners. Right. So these are the things that people tend to do when they start to think about a transaction. They don't figure out what's important to them. And then they go into meetings with people and they're just being whipsawed by what the people's strategy is. I always try to sit down with a founder and say, what are you playing for? What motivates you? And then work backwards from that. And if working backwards from that fits our strategy, great. If it doesn't, I'll introduce them to other people who it does fit their strategy, because there are thousands of ways to make money and thousands of ways to build a business. So if you're thinking about an investor, figure out what you want first and foremost. Now, when you go to start to have those serious conversations, just realize, really vet these people. Like my joke for private equity is everybody tries to get you in the middle of the river and then drown you, basically, right? Like they take you out, they're like, oh, it'll be so fun, it'll be so nice. And in the middle, they start changing terms and doing other things that, I wouldn't be proud of doing as a business person, and you probably wouldn't be proud of doing as a business person. And so then if you find that person who's really serious, who you can really trust, there's sort of two things that you can really focus on. Most people focus on valuation. I think it's like this vanity metric that people get really excited about. But terms are even more important than valuation. So if you're going to do the terms, that's where you have to start asking yourself, do I want a minority? Do I want a majority? What sort of say at the table do I want? How does this work? So I bring all this up to say that it's a hugely personal decision. You should not do it quickly. You should not, quote unquote, trust the experts. Your banker, your lawyer, other people will potentially lead you astray. You've got to trust your gut. You got to vet the person, and you got to have really frank conversations about like where you want to take the business ultimately. So for us, like what's been fantastic for us is we sit down, we know that someone wants to stay involved in the business, whether it's as CEO or with one of their hired people being CEO or someone that we mutually identify together as CEO. We keep the team as is because they're the engine of it. We try to make them better, as Jason was pointing out. And you just got to have alignment about that compounding strategy. Like if we want to grow X% and they want to grow half of X%, we're both going to not get along. So you make that plan going in and you just execute the plan. And of course, things go sideways sometimes. It's the nature of business. But if you trust each other, if you're on the same page, if you're good people, I mean, that's really what we aspire to be. We aspire to be like the good guys at private equity, so to speak. You just grind the business together.
It sounds a lot like hiring. I've been doing a lot of hiring lately. And it's the same thing as, and I love what you said, that you work back from the end goals. So like with everyone, we're always asking like, what do they want? Like what are those things? What is the lifestyle that you want to live and all those things? Because it just pretty much knocks out so many, people down the road where it's like, they'll say that they want the job, but then really they don't want the lifestyle that goes with it. So it's kind of counterintuitive to start with the job or the business at that point.
If you don't have alignment going in, you're just going to have friction the whole way. That's just how it is. But again, the thing that's unique about this is you never get to fire them in the case of your investor. So like once they're in, they're in. Yeah. And the second piece is really what I said at the top. Like if you take the advice on where you want to wind up from investors, they're all just going to talk their book and they're going to smile at you. They're going to compliment you. They're going to tell you the best possible stuff in the world. And then about 9 months in, you're going to have this feeling of, well, I just wasted 9 months of my life. I mean, I literally talked to a company today who was going really deep with a PE firm for literally 8 months. And at the end of it, they're like, the investment committee said the deal is too small. And you're like, deal's too small after 8 months. Like I'm bigger than I was 8 months ago. Like how am I too small? It's just, and again, that's a function of like mercurial, bureaucratic, like whatever it is, people just root that out as soon as you can.
Yeah. Love it. Let me ask you a question. I've heard through the grapevine that like when it comes to insurance agencies that under 2 million, no private equity really cares about going under. Like there's like a sweet spot for private equity. There's a spot where it's like over 10 million where the multiples might jump. Yeah. What are those kind of like cutoff points, or how do you see it?
And is that revenue or EBITDA for the numbers 2 and 10?
I've heard people go off both, but I would speak to that as well.
So this gets to where there is no true rule, no bright line rule, but generally, and I mean, I'll rationalize it and also make fun of it. The bigger you are, the more valuable you are. And the rational reason is you're more established, you're more mature, you've probably ironed out the kinks, et cetera, et cetera, et cetera. But I mean, the other argument for it is like, let's be honest, the more money people can shove into you, the more excited they are about you, because so much of Wall Street is a game of getting money out the door so you can raise more money and charge more fees, basically. So I'll talk about it in terms of EBITDA. So generally speaking, less than 10 million of EBITDA. So, earnings for interest, taxes, depreciation, but there's not a lot of that in agencies. 10 million is kind of that number where a lot of firms will really start to pay attention. Now that number will creep up over time and it will become a bigger number with inflation and everything else. But the core view here is the bigger you are, the more people can invest in you. And as a result of that, the more competitive it can get and the higher the valuation you can get. That being said, our firm likes to stay under 10 million of EBITDA because you find businesses that still have a lot more room to run. And you also have some of these conversations that are more founder led as opposed to banker led. Like if you're 10 million plus EBITDA, you're probably hiring a bank, they're passing around a deck and everyone's just competing over who's going to pay more, which is fine because sometimes the second highest or third highest bidder wins the deal. It's not always just who pays more, but if you're sub 10 million of EBITDA, the idea here that's interesting is you buy a business, you put your stake in the ground, you add smaller businesses around it, you integrate them, you make those better. And pretty quickly, you're well north of 10 million EBITDA yourself. And you kind of do the 2 or 3 years of hard work, and now you're in a completely different stratosphere. The one thing I would say, though, for folks who are listening that, might be tired, might just be tired of the grind, there's always a buyer at some multiple, might be lower than others, for a business that's being rolled into another. So what you're hearing kind of around the 2 or the 10 or anything, that's usually probably for the initial platform investment where you need a certain business of a scale to plant your flag in the ground. But if you're just ready to retire, I mean, there's almost always some home for the business at any scale.
I would love to know your advice on size of book. So if let's say you lost your position right now and you wanted to start your own firm and you're only going to buy insurance agencies, you're going to go out and buy independent agencies. You're starting smaller, so smaller capital. You're probably looking at smaller agencies, but you know that the growth strategy would be to acquire and stack them, right? How would you go about that?
I think the most important thing is to be valuation disciplined while also having like a baseline level of quality. So what do I mean by that? If you're kind of literally bootstrapping, because even that kind of merger strategy is a bootstrap strategy. It's like, how do I buy something and then buy something bigger? And it's a great strategy for folks who are listening and want to do something entrepreneurial. Stay where multiples are low. And that means smaller companies. That means small books of business. do the hard work of integrating a handful of small books of businesses as opposed to buying one that is 2 million, buy 5 that are 400,000, so to speak. The one qualifier to that, though, really low valuations sometimes are value traps because you're buying something that's toxic or broken or even worse, like fraudulent. So you do have to have some baseline level of quality, but I wouldn't ask yourself at that scale to be like, oh, what's the absolute best line of business I could be in? I would ask yourself, what is the absolute best line of business I could be in relative to the valuation? Because you can always bootstrap your way up into the thing that is the best line of business ultimately. Like valuation matters a lot, especially if you're going to do something small and nimble at the low end of the market.
Yeah. I always think the best strategy would be to start. I see so many, it seems like there are so many people ready to retire with these older books that haven't grown them forever, but they're established books, like, and they're small. I just think it would be such a good strategy just to buy, like, absolutely no outbound. Just all you're doing is acquiring, stack them, and then going to a certain level and then selling that as a
So I think the older folks who don't want to retire is a great strategy because it's good for everybody. Like we're investing in a third party administrator right now that's doing that, and it winds up being great for the sellers. Where the sellers don't want to invest in technology and they see this wave coming. They don't have a succession plan. There's never anybody who kind of grew into the business they could hand it off to, family or otherwise. But $2 million is $2 million. So if they get a chance to exit at $2 million and go retire, like they'll take it. And the multiple on that $2 million might not be as much as it would be if they were, 20 million of scale. So that works in and out of brokerage. It's a great strategy in general. I think the key thing that I'd add to what you just said, though, if you agglomerate these businesses, you have to have growth. And so if like whether you grow them yourself or otherwise, if you bought a business that was small and then you grew it, that'd be a super valuable asset. If you bought a business and it was stagnant, you're creating a house of cards. The number one thing I would say about these kind of consolidation strategies is that if you ever lose organic growth, you're cooked. But if you're growing organically and you're aggregating, sky's the limit.
So you have to buy well-functioning units that are already plug and play growth.
But again, enterprising young fellas who buy something can grow the thing faster than the past person did when they've been just kind of phoning it in for 5 or 10 years. And the other thing too is you'd ask yourself, okay, well, was that person who's leaving, was it just relationship driven and that's why they were so successful? And at the low end of the market, it's very common to have like an earnout requirement or other performance covenants that require them to leave the business in good hands, so that for them to get the full proceeds 2 years later, the people who used to be their relationship now believe you just as much as them.
So during due diligence, I'm curious, like, just for entertainment value, what kind of surprises have come up? What are the types of things that you find, and how because I think that it could help somebody who's considering talking to a private equity firm to avoid doing those things, right?
Well, so in terms of talking to a private equity firm, I think folks who are acting in good faith and legitimate, I'll come to that in a second. So for most people in the call, I'm going to assume you're all good people and you're going to do your best. Maybe I should have said this for like the craziest experience. Like I've looked at deals where you go to like research the person and you can be like, oh, they have an FTC order for scamming grandmothers with like, clickbait, And then by the way, like really professional investors go back that person if you're in the middle of a bubble, like we were a couple of years ago, biggest surprises are almost always that you get in and you realize that people have done toxic stuff, or sometimes you realize the business is a fraud, but you figure that out pretty early in diligence. Like if you, because fraud's almost always, they report numbers that are too good to be true, right? And you look at the numbers, you're like, well, that's amazing. You're the first agency to ever have an 80% EBITDA margin. They're like, I know, I'm doing something right. And you're like, nope, you're a fraud. So try to figure that out early. If I'm a good faith actor, first and foremost, I try to pick my counterparties appropriately, right? And it goes back to everything, like the screening, the sorting, what we set up top. People would love to be like, oh, I've got to have like my data room appropriate. I've got to have all my things like, if that's really what you're concerned about, you should hire a banker or a broker. But candidly, I've seen brokers miscalculate numbers, and you almost then like want to go back to the company and be like, so this guy you're paying is not reporting it correctly. Just so you know, I don't want to be awkward about it here. In general, if you are hunting for the right type of partner, if you're telling people what they want so they can give you a quick no, And if you're just being transparent and forthright about your numbers, you're going to get an honest answer. And at the end of the day, the same way that a carrier and an agent, the numbers have to be the numbers. You can't defy the laws of gravity, whatever those rules might be, and everyone's rules are different. It's the same for an investor. If they need you to be X or they need you to be Y, they can tell you, I love you, you're fantastic, can't do it right now, but here's what I can do to be helpful. So that's what I would say in general.
Super cool. Let's I'd love to start talking a little bit about AI and like what we're at this kind of this crazy point right now where AI agents are just like the possibilities are endless at this point. How are you guys looking at all like your portfolio and maybe moving some of the processes to like AI and what's possible with that?
So it's really early days. I'll give some views, and if you guys have me back in the future and all the views are wrong, I'll be the first to be like, yeah, it was early days. What can you say? But it is important to try to have an opinion. So the analogy I keep using is what happened with the internet. And maybe AI will be a lot faster. I totally get it. But compared to the internet, AI is less about totally new use cases, and it's just more about even greater efficiency than we ever saw. And then some people like to say, well, it's going to happen overnight. To which really smart people will also point out, like, do we have the power for it? It takes a while to build some power plants. So I just think in general, we're kind of at that stage where it's going to change the world, and it's going to change the world on a multi-year, multi-decade time frame. It's not going to change the world in the next, it will change the world, but not totally change the world in the next 3 years, plus or minus, if that makes sense. So where do we like to stay? We like to stay in things that are relationship driven, which is very much B2B, but agency candidly has much more of relationship driven than a lot. We like to stay in things that are complex. And we like to stay in things where the internet didn't disrupt it. It actually made it better and more efficient. So in general, if you look at your book of business, the lines you're in, the more simple things are probably going to get more commoditized. Your more simple outreach is probably going to get more commoditized. But the more complex lines, the more complex relationships, those are probably going to be places that are even more defensible. Oh, and by the way, you're going to actually have the ability to use off-the-shelf AI agents yourself to make yourself more productive and probably more profitable. So looking at insurance and even outside of insurance, there's a couple of themes we're seeing. Like everyone should be investing in this to the capacity they can. You shouldn't break the bank. You shouldn't mortgage your house, right? But you should like invest in this to the capacity you can. We have companies outside of insurance and in insurance who are finding a couple of things. One, it's automating a lot of the kind of just grunt work communication tasks. And then when things get complex, it kicks it over to a person who actually can solve the problem. So that's a really helpful piece. Separately, when you think about all the number of reports and other stuff that have to be written, that's going to be like hugely productive and effective. The only thing, and I mean this as someone who lived in Silicon Valley for a few years and go back regularly, people in Silicon Valley still think they're like the overlords of everything else. So the terms and conditions and the actual data integrity, like I would be careful what I'm putting into systems at this point, for what it's worth. But I'm sure there's going to be some, embarrassing moments for all sorts of the big players involved. And I'm sure we'll only get better and we'll get more institutional, but there will come a time where writing reports and everything else will just be so much more streamlined as a result of this. So, that's all we're thinking about today for what it's worth. But lastly, SEO is really like search engine optimization is really struggling. So if that's something that you've prioritized, you might want to think about more outbound or more other stuff to kind of pick up the slack of that. Because there's this notion of like answer engine optimization, which is going by different terms, but it's just not what Google and SEO were. So you just sort of have to fill that hole one way or another.
Yeah, as far as like advertising your own business.
Yeah, exactly. Like for instance, there's a company that I'm close to that they saw their leads through Google go down 70% at the same time that their price on Google was going up 10x. So, it still works for Google, right? Like clicks are down, prices are up. And that's not true for all things, but for that specific company. But to the credit of that company, they just very quickly figured out how to do outbound sales for the first time. They had never really built that muscle, and then they were able to build the muscle when they were forced to. So I wouldn't be asleep at the wheel if I depend on SEO. I'd really diversify.
Yeah, I love that advice. It's funny that you said that. Like I was just looking into LLM SEO, which is very similar, but there's some nuances. I've noticed. I use ChatGPT almost exclusively to search the web now, just because it's so much more efficient. And yeah. So like, I started noticing that, some like it'll give you like 5 or 6 companies for things, right? But like it throws in a couple wild cards, like a couple newer companies. So like I was looking into like, why are those newer companies being shown? And so there are some nuances to that. But again, you're looking at 5 or 6 companies out of all the companies. So you're going to be shooting for those 6 spots. That's tough.
Absolutely. And it's also the kind of thing where like, we don't know how effective those clicks are yet. The thing that made Google was kind of out of the gate. Geico and everybody else was just seeing really great return on ad sales or ad spend. It's too early to know. I mean, this is an anecdote and I don't want to belabor it, but like I was trying to find this pharmacy in New York recently. ChatGPT was like, oh, I found the magic pharmacy that Google never found. And then like, it's not a real pharmacy. They had this listing from a website from like 3 years ago. No. So you do get to this place where like the other advice is check everything that AI serves up because it's not always right. We're still the guinea pigs training the model right now.
Yes. It's like, especially when you get into more complex models, it's like having a model check the other models answers for things and like cross-reference and give me 3 different sources and
if I were a scaled agency or working for a captive that had scale, I would lean into any AI agents I had on kind of the front end, and that's where I'm seeing agencies do the best work. And just realize that there's going to be some hiccups along the way, but we've all experienced the hiccups, and bring in the humans for the things that really, really matter and build your book of business around things where humans really, really matter. So complex, high value, high emotion, sort of high value items.
Lean into being people.
Well, it's true. Like trust is going to be even more important than ever. Like if people actually think that you're like a real person who genuinely cares about them and is not here to scam them, it's going to matter more than ever.
Yeah, I agree. 100%. I love it, man. What's one piece of advice that you give an insurance agency owner going into the future?
I would absolutely say to just keep going. Like too often people stop for all the wrong reasons. And as long as you're pointing in the right direction, you just keep going. You put one foot in front of the other, you square your shoulders, and you go to the future. Now, if you need to change your direction because nobody wants you to walk off a cliff. But if in your heart of hearts, you got the right team, you got the right product, you got the right end markets, you just keep going.
Yeah.
Awesome. Cool. So plug your stuff, man. Where can people check your company out? And you,
Brandon Wolfe at Jordan Partners. You can reach me at bw@jordan-partners.com. And if people are looking to build a category killer, I'd love to meet them. And even if they're not, still love to meet them. There's never enough friends in this life.
Awesome. Thanks so much.
Thank you.
I really appreciate it.
It was a ton of fun.
Great to have you on, Brandon.
Great to be here.
Awesome, man.
We'll hold you to that and bring you back on for the AI discussion to see if you nailed it.
I love that. I'm the first person to rub my own face in it, so I'm happy to do it.
You have to, right?
Awesome.
Cool, man.
That's
Thank you so much.
Thank you.
Thanks, Brandon.
Thanks. See ya.